looking at Chapter 18 and revenue recognition and the new revenue recognition standard, which is a converged standard called revenue from contracts with customers. We will be looking at some of the fundamentals and the background, the new recognition standard, the actual process itself, some issues with revenue recognition, and then the presentation and disclosure of revenue recognition. In this chapter, we'll start with understanding what the fundamental concepts are related to revenue recognition and measurement. Understand and apply the 5-step revenue recognition process, which is brought to us from the converged standard revenue from contracts with customers. Applying that 5-step process to some major revenue recognition issues. Obviously, we cannot cover every possible variable because they are infinite. And then the presentation and disclosures that exist regarding revenue. So, relatively recently, FASB and IASB issued a converged standard on revenue recognition entitled Revenue from Contracts with Customers. And the reason they did this was to address some inconsistencies and weaknesses of vast previous approaches and standards. A comprehensive revenue recognition standard now applies to a wide range of transactions and industries. No longer is it very specific to, say, maybe the hotel industry or the construction industry or the manufacturing industry. Now it goes across multiple industries and provides pretty definite and defined guidance in how we do this. So that standard is called Revenue from Contracts with Customers, and it adopts what's called an asset liability approach. It accounts for revenue based on assets or liabilities arising from contracts with customers. And it has a requirement to analyze that contract with your customer to indicate terms, measurements, consideration. And without contracts, companies cannot know whether or not their promises will be met. This new converged standard provides a much more robust framework for addressing revenue recognition issues. It improves the comparability of revenue practices across entities, industries, jurisdictions, and capital markets. When we come to presentation, it has created some simplification to the preparation of our financial statements by reducing the number of requirements to which companies must refer. And it's added disclosure to help financial statement users better understand the amount, timing, and the uncertainty of revenue that is recognized. The new standard adopts this asset liability approach to revenue recognition. Companies account for revenue based on the asset or liability arising from those contracts with the customers. The new standard identifies the key objectives of revenue and specifies a 5-step process the company should use to ensure the revenue is measured and reported correctly. And it culminates by stating the revenue recognition principle, i.e., revenue is recognized when the performance obligation is satisfied. While much of this may seem common sense, when we are in a business setting and things are occurring, there's a lot of gray area, a lot of fuzz, a lot of things that have occurred to create confusion in industry over the years. And with that, FASB tried to answer that with many standards that were industry specific. And the more standards there are, then the more interpretation. Argumentatively, we could say, oh, we're more of this type than we are this type, so let's go with the one that better benefits us. What FASB and the IASB did is they said, okay, no more, let's look at this just as a very broad concept and how can we answer it. And to do that, they created the 5-step process for revenue recognition. We'll go through all of these steps as we move forward using Boeing as an example. So let's assume that Boeing Corporation signs a contract to sell airplanes to Delta Airlines for $100 million. Going through the 5-step process. First, we have to identify that a contract exists with the customer. A contract is an agreement between two parties that creates enforceable rights or obligations. In this specific case, Boeing has signed an actual contract to deliver airplanes to Delta. Contracts have commercial substance. There is approval by both parties. It's going to identify the rights and the obligations. And payment terms are going to be identified. There's also probability that the consideration within the contract will be collected. The second step is to identify the separate performance obligations in the contract, because some contracts are going to cover multiple things, or they're going to have different thresholds, or any number of variations can exist in a formalized contract for something such as purchase of airplanes. For this specific example, there is only one performance obligation: to deliver an airplane to Delta. If Boeing's agreed to maintain the planes, then there's a separate performance obligation that is recorded for that promise. Let's look at step 3. Step 3 is determining the transaction price. So the transaction price is the amount of consideration that a company expects to receive from the customer for the exchange or the transfer of the good or the service. In this case, the transaction price is very straightforward. It is $100 million. Step 4 is to allocate the transaction price to separate performance obligations. In this case, because there's only one obligation, there is no allocation necessary. However, if there were multiple obligations housed within the contract for one transaction price, then we would need to engage in an allocation. And then step 5 is to recognize revenue when each performance obligation is satisfied. So Boeing recognizes the $100 million of the sale of the airplanes to Delta when it satisfies that obligation. It delivers the airplanes to Delta. Now, we've really looked at this at a very broad and simplistic type of situation. So the buying of one element. Business is not always that straightforward, nor is it always that cut and dried. Sometimes there are steps, there is progress, there is 4 or 5 different types of things that are occurring inside one contract for one transaction price. So let's really look more deeply at each of these 5 steps. So identifying the contract with the customers. This is relatively easy when we think about going to Starbucks and purchasing, say, a coffee. You walk up to the counter, you enter into a contract with the barista when you say, I would like a grande mocha latte. I don't even think that's actually a Starbucks drink, but that's okay. They say, okay, that'll be $5.82. You've now entered into a contract. You have an agreement between two parties that have enforceable rights or obligations. Contracts can be written, oral, or implied from a customary business practice. You have an oral contract with the barista. The enforceable right. You have the right to receive a grande mocha latte. and you have the obligation to remit consideration of $582 in order to receive that grande mocha latte. We enter into contracts all the time without actually realizing we're doing that. They're oral contracts or they're basic customary business practice. So continuing to look at contracts with customers. Companies apply the revenue guidance to a contract according to some basic criteria. Contracts have to have commercial substance. Both parties have to agree, or all parties have to agree to the contract. There's an identification of the rights of the various parties that's established. Payment terms are identified. And the probability that your consideration is going to be collected. Revenue is recognized only when a valid contract exists. The company obtains rights to receive consideration from their customers and assumes obligations to transfer goods or services to the customer. This is a performance obligation. If a contract is wholly unperformed, and each party can unilaterally terminate the contract without compensation, then revenue should not be recognized until one or both the parties has performed. Until performance occurs, there is no net asset or no net liability that has occurred. So let's look here at contracts and recognition and some basic revenue transactions. On March 1st, 2017, Margot Company entered into a contract to transfer a product to Soon Yoon on July 31st, 2017. The contract is structured such that Soon Yoon is required to pay the full contract price of $5,000 on August 31st, 2017. The cost of goods transferred is $3,000. Margot delivers the product to Soon Yoon on July 31st, 2017. The journal entry to record the sale and the related cost of goods is on July 31st, because they have the contract to transfer the product on July 31st. Margot delivered the product on July 31st. This is even though consideration is not required to be paid until August 31st. We have fulfilled our performance obligation. We have an accounts receivable of $5,000 and then sales revenue of $5,000. Now, assuming the perpetual inventory system, we would have cost of goods sold of $3,000 and a reduction to our inventory of $3,000. So let's look at the parts of the contract. Is there commercial substance? Yes, there is. There would be a transfer of a good. That good has $3,000 worth of value to Margot. And Soon Yoon will receive a good that has $5,000 worth of value to them. There is commercial substance to it. Both parties entered into this contract, so there is approval. And the basic rights of the parties are defined. There will be full contract price of $5,000 paid on August 31st. Product will be delivered on July 31st. Payment terms were also identified in that. And there's probability that this consideration will be collected. So moving forward, on August 31st, when they receive the cash from Soon Yoon, we would increase our cash $5,000 and reduce our assets in the accounts receivable section by $5,000. Now the stickler is in identifying separate performance obligations. So a performance obligation is a promise to provide a distinct product or service to a customer. It's distinct when the customer is able to benefit from the good or service on its own or together with other readily available resources. The objective is determining whether the nature of a company's promise is to transfer an individual good or service to a customer or to transfer a combined item or items of which individual goods or services are inputs. A company must provide the distinct product for each performance obligation. So let's look at an illustration from General Motors. So let's assume that General Motors sells an automobile to marquee auto dealers at a price that includes 6 months of telematics services such as navigation and remote diagnostics. These telematics services are regularly sold on a standalone basis by General Motors for a monthly fee. After the 6-month period, the consumer can renew these services on a fee basis with General Motors. So the question is whether General Motors has sold 1 or 2 products. So the vehicle itself is a product. It can stand alone. You can have the vehicle without the telematics services. But General Motors can also sell as a standalone basis those telematics services. And you don't have to have this specific vehicle to get those telematics services. So if we look at General Motors' objectives, it appears that it is selling 2 goods. Both are distinct and they can be sold separately, and they are not interdependent of each other. So let's look at another illustration. With this one, we have Softtech. And Softtech Incorporated licenses customer relationship software to Lopez Company. In addition to providing the software itself, Softtech promises to provide consulting services by extensively customizing the software to Lopez's information technology environment for a total consideration of $600,000. In this case, Softtech is providing a significant service by integrating the goods and services, the license, and the consulting services into a combined item for which Lopez is contracted. In addition, the software is significantly customized by Softtech in accordance with specifications negotiated by Lopez. Do these facts describe a single or a separate performance obligation? At first glance, looking at it, it seems like the license and the consulting services might be separate. But the consulting services are required because of the license and the customization. We are actually creating a single new type of a product, something that is customized to Lopez. They are distinct services, but they're interdependent of each other. And so we would count them as a single performance obligation. So you can see where it can get a little bit muddy depending upon the perspective you take into account. Step 3 is transaction price and determining What is the transaction price? Transaction price is the amount of consideration that a company can expect to receive from a customer in exchange for transferring goods or services. Typically, it's a fixed amount over a short period of time. In other contracts, companies must consider such a factor such as variable consideration, the time value of money, non-cash consideration, and consideration paid or payable to the customer. Variable consideration includes future events occurring, such as price concessions, volume discounts, rebates, credits, performance bonuses, royalties. A company has to estimate the amount of variable consideration it will receive from a contract to determine the amount of revenue to recognize. First, we have what's called the expected value. This is a probability-weighted amount in a range of possible consideration amounts. It may be appropriate if the company has a number of contracts that have very similar characteristics. It can also be based on a limited number of discrete outcomes and probabilities. Then we have the most likely amount. The single most likely amount in a range of possible consideration outcomes. This may be appropriate if there are only two possible outcomes. So before we go much farther when we're looking at transaction price, let's look at estimating some variable consideration, because this isn't unusual. It's very normal. So we have the probability weighted amount in a range of possible considerations, and then the most likely amount. Let's use Peabody Construction, who entered into a contract with the customer to build a warehouse for $100,000, with a performance bonus of $50,000 that will be paid based on the timing of completion. The amount of this performance bonus will decrease by 10% per week for every week beyond the agreed upon completion date. The contract requirements are similar to contracts that Peabody has performed previously. Management believes that such experience is predictive for this contract. Management estimates that there's a 60% probability that the contract will be completed by the agreed upon completion date, a 30% probability that it will be completed 1 week later, and only a 10% probability that it will be completed 2 weeks late. Well, this is kind of a fussy and messy revenue situation. We have the $100,000 of the contract itself, and then we have the performance bonus of $50,000. And that is completely based on timing and completion. This is not unusual, and in fact, a lot of very large products will have performance bonuses. Or what they may have is that maybe we will build this bridge for X amount, and then for every set amount of time that you come in late, you actually lose some of the original consideration. Maybe it's not performance bonus and you lose part of that, you lose part of the original, or you're going to give up a certain amount. This happens often with government jobs. So how are we going to deal with this? Well, there's a lot of belief that this is like many of their other contracts. They have a pretty solid historical experience that they can use for predictiveness. So we're going to use the probability weighted method. So there is a 60% chance of $150,000, which is $90,000. There's a 30% chance of $145,000. That would be $43,500. And there's a 10% chance of $140,000, which is $14,000, giving us a total of $147,500 based off probability weight. Now, your probability can only equal 100%. And your amounts are going to differ based off that completion. Because remember, that $50,000 performance bonus went down the farther out we went. Now, if we didn't have this, we would look for the most likely outcome. If management believes they will meet the deadline and receive the $50,000 bonus, remember, most likely is like an either or almost. The transaction price would be $150,000. This is the outcome with a 60% probability. With the transaction price, we only allocate variable consideration if it's reasonably assured that we will be entitled to that amount. Companies may only recognize variable consideration if they have experience with similar contracts and are able to estimate the cumulative amount of revenue. And based on experience, it is highly probable there will not be a significant reversal of previously recognized revenue. If these criteria are not met, then revenue recognition is constrained. Now, remember, I mentioned just a few minutes ago, another consideration is sometimes the time value of money. So when a contract or a sales transaction involves a significant financing component, we need to take into consideration the time value of money. This is when the time period for payment is greater than a year. Revenue is determined by measuring either the fair value of the consideration received or by discounting the payment using an imputed interest rate. The imputed interest rate is more clearly determinable of either the prevailing rate for similar instrument of an issue with a similar credit rating, or a rate of interest that discounts the nominal amount of the interest of the instrument to the current sales price of the goods or service. Interest is accrued on the consideration to be paid over time, and the company reports as interest expense or interest revenue. So let's look at some extended payment terms that can occur in contracts. Again, this is not unusual, especially with a significantly large project. So on July 1st, 2017, SEK Company sold goods to Grant Company for $900,000 in exchange for a 4-year zero interest-bearing note with a face amount of $1,416,163. The goods have an inventory cost on SEK's books of $590,000. So the question is, how much revenue should SEK Company record on July 1st, 2017? How much revenue should it report related to this transaction on December 31st, 2017? Well, first and foremost, we have a notes receivable that comes into play with a face amount of $1,416,163. We give that sales revenue of $900,000 and then a discount on notes receivable of $516,163. This is based off imputed interest and the time value of money. The present value of this note at 4 years with imputed interest at a rate that we are not aware of at this time. We recognize the transfer of inventory to costs of goods sold. And then with an imputed interest rate of 12%, at the end of the year, December 31st, 2017, we would recognize discount on notes payable of $54,000 and interest revenue related to that period of $54,000. This is 12% times 1/2 times 900,000. If the time period is less than a year, you are not required to recognize the time value money. If it does cross over that year period, it is absolutely necessary. Now, not always is consideration cash. We often think in terms of cash, but sometimes consideration can come in the form of goods, services, and other things. Non-cash consideration in exchange for the sale of your goods or services does not negate revenue recognition or measurement. Revenue should be measured using the fair value of what was received. If that can't be determined, the selling price of the services performed or the goods sold should be estimated and then used to measure the revenue. We then have consideration paid or payable. So these are some additional factors that come into play. And they include things like discounts, volume rebates, coupons, free products, or services. In general, these different types of items will reduce the consideration received and the revenue recognized. So what is consideration paid or payable to the customers? Let's look at Samsung Company as an illustration. So they offer their customers a 3% volume discount if they purchase at least $2 million of its product during the calendar year. On March 31st, 2017, Samsung has made sales of $700,000 to Arctic Co. In the previous 2 years, so historically, Samsung sold over $3 million to Arctic in the period of April 1st to December 31st. So there is a high likelihood that Arctic is going to cross this 2 million mark and receive the 3% volume discount. So the amount of revenue we would actually recognize for the first 3 months of 2017 is not the 700,000. It is actually 679,000, because it is highly probable that the rebate volume discount of 3% is going to actually occur. Assuming Samsung's customer meets that discount threshold, we would make the entry to receive the $679,000 worth of cash and close out the accounts receivable. If, for some reason, the customer didn't meet the threshold and will receive $700,000 in cash instead, we would reduce accounts receivable by $679,000, and we would credit sales discounts forfeited for the $21,000 or the 3%. So finally, we're going to move forward to step 4. Step 4 deals with allocating the transaction price to separate performance obligations. First, we have to recognize them before we can even allocate it. So now we've recognized the different performance obligations. Now we have to figure out how to allocate a single transaction price amongst all the variables. If more than one performance obligation exists in a contract, an allocation of the transaction price is needed. This allocation should be based on the relative fair values of the various performance obligations, referred to as their standalone selling prices. This information is not available. Companies should use their best estimate of what the goods or services might sell for as a standalone unit. To do this, so to determine what would be the selling price of each of these as a standalone unit, there are a couple approaches. I know you're shocked that GAAP has given us such a large amount of actual guidance, but of course, there are options. First is the adjusted market assessment approach. You need to evaluate the market in which the product is selling and estimate the price that customers in that market are willing to pay for those goods or services. The second is expected cost plus a margin approach, where we forecast expected costs of satisfying a specific performance obligation and then add an appropriate margin for that good or service. And then there's the residual approach. This is if the standalone selling price of a good or service is highly variable or uncertain, then we estimate the standalone selling price by reference to the total transaction price less the sum of the observable standalone selling price of other goods or services in the contract. And the rest of it must go to the one that is highly variable. So to clear up a little bit of potential confusion, you've received a lot of information on a variety of ways now that we deal with this allocation. Let's look at Samsung Handler Company. And they are an established manufacturer of equipment used in the construction industry. Handler's products range from small to large individual pieces of automated machinery to complex systems containing numerous components. Unit selling prices range from $600,000 to $4 million and are quoted inclusive of installation and training. The installation price does not involve changes to the features of the equipment and does not require proprietary information about the equipment in order for the installed equipment to perform to specifications. So they enter into this arrangement with Chai Company. Chai purchases equipment from Handler for a price of $2 million, chooses Handler to do the installation. Handler charges the same price for the equipment irrespective of whether it does the installation or not. They are going to charge $2 million. Some companies will do installation themselves because they either prefer their own employees to do the work or because of the relationship with the customers. The installation service included in the arrangement is estimated to have a standalone selling price of $20,000. Handler has the following arrangements with Chai. The standalone selling price of the training sessions is estimated at $50,000. Other companies can also perform these training services. Chai is obligated to pay Handler the $2 million upon delivery and installation of the equipment. Handler delivers the equipment on September 1st, 2017, and completes the installation of the equipment on November 1st, 2017, where transfer of control is complete. Training related to the equipment starts once the installation is completed and lasts for a year. And the equipment has a useful life of 10 years. So what are the performance obligations for the purpose of accounting for the sale of this equipment? Handler's primary objective is to sell equipment. Other services, such as installation and training, can be performed by other parties if necessary. So as a result, the equipment, the installation, and the training are 3 separate products or services. Each of the items has a standalone selling price, and they are not interdependent of one another. So if there is more than one performance obligation, such as in this case where we have 3, how should the payment of $2 million be allocated to the various components? The total revenue of $2 million should be allocated to each of those components based on their relative standalone prices because we know what they are. So we are going to allocate this on a pro rata basis. So we have the selling price of the equipment at $2 million, the installation fee of $20,000, and the training at $50,000. So the total standalone selling price, if we sold each of the components on their own, would be $2,070,000. We take the equipment's $2 million, divide it into the $2,070,000 to get its pro rata share, and then we multiply that by the transaction price of $2 million to allocate $1,932,367 to the equipment. We then take the installation's $20,000 standalone price, divide it into the $2,070,000 to get its pro rata share, and we multiply that by the $2 million transaction price to allocate $19,324 to the installation. We then have the $50,000 training standalone price, which we divide into the $2,070,000 to get its pro rata share, and multiply that by the $2 million transaction price to allocate $48,309 to training. So on November 1st, we make this entry to record both our sales and service revenue on the installation, because that's when control was handed over. We also have some unearned service revenue in the form of the training. We start with the receipt of $2,000 worth of cash. We recognize $19,324 in service revenue for the installation. We have $48,309 of unearned service revenue. That's trainings for the next, I believe, year. I can't recall off the top of my head what that period was. And then actual sales revenue of $1,932,367. Assuming that the equipment has a cost of $1,500,000, we would recognize cost of goods sold of $1,500,000 and a reduction to our inventory of $1,500,000. We recognize the revenue from the sale of the equipment once the installation is complete, because at that point, that is when handler cedes over control. We would also recognize the revenue from the installation fee, because that is when that performance obligation also has been fulfilled. So as we go through the year and we reach December 31st, handler is recognizing the training revenue on a straight line basis starting on November 1st. So there's $4,026 per month for each month for 1 year. Now there may be a different method that may work, such as percentage of completion or something else, depending upon the terms of that part of the obligation. So to recognize the training revenue for 2 months, we take $8,052 from our unearned service revenue and recognize it as service revenue in the current period. We continue to move forward to the end of the next year, and we need to recognize the remaining training revenue in 2018. We're, of course, assuming that adjusting entries are made at the end of the year and not on a monthly basis. So we have unearned service revenue of $40,257, which is the original $48,309 less the $8,052 that was allocated to 2017. Now, last but not least is recognizing revenue when or as each performance obligation is satisfied. As you see here, there was definitely a clear delineation of when we satisfied some of our performance obligations. Revenue is recognized when the obligation is satisfied. A company satisfies its performance obligation when the customer obtains control of the good or service. The performance obligations can be satisfied at a very specific point in time or over a period of time. Companies recognize revenue over a period of time if the customer controls the asset as it is created, or the company does not have an alternative use for that asset, and the company has a right to the payment and the right is enforceable. So let's just real quick look at some control indicators. So if the company has a right to payment for the asset, that is a control indicator. If the company transfers legal title to the asset, that is a control indicator. Control has transferred. If physical possession transfers. If the customer has the significant risks and rewards of ownership, or if the customer has accepted the asset. Now, measuring progress towards completion can differ. The method for measuring the process should depict transfer of control from the company to the customer. It should mirror what really is happening, should not necessarily be an arbitrary thing. The objective of the method is to measure the extent of the process and the progress that is occurring in terms of costs, units, or value added. So let's take a minute and look at recognizing revenue when each performance obligation is satisfied. We identify the contract with the customers. A contract being an agreement with enforceable rights or obligations. We take our revenue guidance and we apply it to these contracts as they occur. We move into step 2, identifying all those separate performance obligations. There can be a lot of different obligations within one contract for one transaction price. How we account for it is going to be based on whether or not products are distinct within the contract. We determine what the transaction price is, what amount of consideration, not amount of cash, consideration that we can consider. And within consideration, there may be variable consideration. We may have to take the time value of money into account if there's a significant financing component, non-cash consideration, and values assigned with those items that are going to be transferred. And if there's any consideration paid or payable to the customer, other factors that need to be taken into account that may reduce the revenue. We then allocate that revenue price we have ascertained to the separate performance obligations, depending upon what information we have. It can be based on the standalone selling basis, or it could be the adjusted market assessment, the expected cost plus margin, or a residual approach. And then finally, as we are satisfying each of those performance obligations, either at specific points in time or over periods of time, we recognize revenue in the periods as those obligations are satisfied. So we have talked about the 5-step revenue recognition process. Next, we'll apply that 5-step process to some major revenue recognition issues. But we'll do that in a separate video and allow you to digest this information before jumping into looking at all of these other little things that occur that can throw kinks into these basic 5 steps. It's 5 steps. We have some very definitive guidance on it. It's not 100% black and white, but it has been made much easier for us to recognize revenue with this guidance. But the world of business is very colorful, and it's when those other colors come into play that we need to sit down and really critically analyze all the situations in light of our 5 steps. What are some of the other things that come into play?